Hi everyone, welcome again to our channel. Today we are going to discuss about agricultural finance in banking awareness. Agriculture plays a very important role in the development of our Indian economy. It accounts for about 19% of GDP and about two-thirds of our population depends upon this sector. Most of the times, farmers suffer from the problem of inadequate financial states. Professional moneylenders were the only source of credit to agriculture till 1935. With the passing of Reserve Bank of India Act in 1934, district, central cooperative banks and land development banks, agricultural credit received inputs and there were improvements in agricultural credit. The cooperative banks advanced credit mostly to agriculture. The Reserve Bank of India, as the central bank of our country, took lead in making credit available to agriculture through these banks by laying down suitable policies. Although the cooperative banks started financing agriculture with their establishments in 1930s, real inputs was received only after independence, when suitable legislations were passed and policies were formulated. Till 14 major commercial banks were nationalized in 1969, cooperative banks were the main institutional agencies providing finance to agriculture. After nationalization, it has made mandatory for these banks to provide finance to agriculture as a priority sector. Thus, agricultural credit required multi-agency dimension in bringing Green Revolution, White Revolution, and now Yellow Revolution. Finance has played a crucial role. Now the agricultural credit, though multi-agency approach, has come to stay. The evolution of institutional credit to agriculture could be broadly classified into four distinct phases. Phase 1 from 1904 to 1969. We call it as predominance of cooperatives and setting up of RBI. The second phase is from 1969 to 1975. Nationalization of commercial banks and setting up of regional rural banks happened during this time. In 1975 to 1990, setting up of NABARD happened, and this is our third stage. And from 1991 onwards, financial sector reforms happened in India, and it was reflected on agricultural credit also. So thus, the evolution of institutional credit to agriculture could be broadly classified into these four distinct phases. Institutional funding of a farm sector is mainly done by commercial banks, regional rural banks, and cooperative banks. Shares of commercial banks in total institutional credit to agriculture is almost 48%, followed by cooperative banks with a share of 46%, and regional rural banks account for just about 6% of total credit disbursement. Now let's see what are the different classifications of agricultural finance. On the basis of time, agricultural finance is classified into short-term finance, medium-term finance, and long-term finance. So what is short-term finance? These short-term loans are generally advanced for meeting annual recurring purchases such as seed, feed, fertilizers, hired laborers expenses, pesticides, weedicides, and hired machinery charges, which are termed as seasonal loans, crop loans, or production loans. These are expected to be repaid after the harvest. It is expected that the loan plus interest would be repaid from the income received through the enterprise in which it was invested. The time limit to repay such loan is 1 year. When it comes to medium term, the time ranges from 15 months to 5 years. Medium term loans are advanced for comparatively longer lived assets such as machinery, diesel engine, wells, irrigation, structure, mills, animals, dairy, poultry, sheds, etc., where the return occurs from the increase in farm asset is spread over more than one production period. The usual repayment period for such type of loan is from 15 months to 5 years. Next we have long-term loans. The loans which are repayable over a long period of time is known as long-term loan. Here it will be above 5 years. Long-term loans are related to the long life assets such as heavy machinery, land and its reclamation of farm building, construction of permanent drainage or irrigation system, etc., which requires large sum of money for initial investment. The benefits generated through such assets are spread over the entire life of the asset. The normal repayment period for such loans ranges from 5 to 15 or even up to 20 years. For the purpose of classification, credit is also classified based on purpose of loan. For example, crop loan, poultry loan, dairy loan, irrigation loan, machinery and equipment loan, forestry loan, fishery loan, etc. These loans signify the close relationship between time and use as well as rate of return or profitability. Sometimes loans are also classified as production and consumption. Security offered or obtained provides another basis for classification. The secured loans are advanced as against the security of some tangible personal property such as land, livestock, and other capital assets. Moreover, the secured loans are further classified on the basis of type of security. For example, the private money lenders usually possess items such as gold ornaments, jewelry, or land as security, which reminds the borrowers about his obligation of repayment. On the contrary, unsecured loans are generally advanced without offering any securities. For example, short-term crop loans. According to the lender, loans can be classified as institutional credit and non-institutional credit. Institutional credit, for example, cooperative loans, commercial bank loans and common loans will be provided by an institutional lender, whereas non-institutional credit will be given by some individual. For example, professional and agricultural money lenders, traders and commission agents, relatives, friends, etc. That's all about agricultural finance. We'll see you with another video. Till then, bye. Happy learning.